Okay, welcome to Accounting 470, Government and Nonprofit Accounting. Today we're going to be looking at Chapter 5 and as well as a couple of the items, the journal entry parts of the homework for Chapter 5. Let's go ahead and switch over to our main screen. We are going to be working through the outline as well as looking at items from the textbook as well. So let's add those to the screen here. Here is our outline. Here is our window. Now the outline, what I've done is I have put it in web mode so that I can make it a little bigger. If the spacing doesn't exactly match. So in other words, some of these underlines may not be exactly where you're looking for, but you can find them by which section it's in and which bullet point. So I won't go through as in detail. I won't read every last thing, although I probably will end up reading most of it. But I want to kind of point out the main things that we want to take away from Chapter 5, and you can go through the outline in detail as part of your study for the exam. At the end, I will go through what's going to be on the exam so that we can so you can have an idea. And likely I will make I'll be available on Wednesday also to kind of talk through it if people have questions. So going on with the chapter, the last chapter, Chapter 4, was actually a big one. It's more of, that was all of the governmental, well, not the governmental activities, but more the general fund accounting, all the governmental fund activities. And that there were a lot of details in this. In this one, there's not as many. We're looking at a specific area of the fund accounting, which is when we're creating or buying big capital assets, such as bridges or buildings or that sort of thing. And so it's a fairly narrow focus, and because of that, there's only but so much specific accounting that we need to take a look at. Plus, a lot of this stuff you will find familiar, and as always, I'll point out where it sort of differs from GAAP. So when we look at this, what are general capital asset? Obviously, long-lived assets. We tip a lot of times in textbooks we say long-term assets when we're talking about GAAP, but remember that depreciation has to do with the useful life. So this is just another common term, long-lived assets. Now, these assets these assets could be used by many different of the funds or the functions or the programs. So even though we're focusing the financing and construction of it in one particular fund called the capital projects funds, the assets themselves are used in a number of different ways in a number of different departments. What can they include? Land building improvements, construction work in progress, vehicles, machinery, equipment, all those sort of things. Of particular note that is different from most corporations is governments have a lot of infrastructure assets: roads, sidewalks, tunnels, bridges, sewer systems, drainage systems, waste treatment facilities. There's lots of things that are infrastructure to the normal running of a city. So that's the one, we've already, except for sort of works of art and historical treasures, which corporations don't have, a lot of these other things we've already visited in sort of the normal corporate life. So we'll focus more on infrastructure. How can they be acquired? Purchase, construction, using your own government workforce. Just like me driving between Sturgis and Spearfish, I'm always passing that point where they've slowed down traffic to where they're putting, it looks like they're basically putting some reinforcement on the shoulder right before and after the bridge. I can't quite tell if those are government workers or if they're contract workers. If I had to guess, I would guess that those are private contractors doing it. And when I say private contractors, they're probably, it's not like they picked them out of a hat. It's probably these are the contractors that work a lot on roads and whatnot. Anyway, when we get to financing, typically we issue bonds or other sort of long-term debt. Other funds can transfer monies in. Obviously, things can be donated. But just remember, whenever we start talking about the bonds and all that stuff, and throughout this whole chapter, we have to remember the difference between a general fund, which is a modified accrual, is we're only talking about current resources. And anything that's a long-term asset or a long-term liability will be covered in the governmental activities under the government-wide statements. So a lot of times we use the same dollar amounts and the same items, but they're just they just have a different focus or a different look or different, I guess, account title when we talk about them in the capital budget fund versus in the government-wide. Specifically, if monies from sources are restricted or committed or assigned, remember that sort of hierarchy of, earmarking money, then it has to go into a capital projects fund. It has to be because you need to set it aside to track it independently. Accounting for general capital assets. Governments have to keep an inventory of all their assets. Typically, they set a threshold. They say over a certain dollar amount, it's considered a capital asset, and they'll keep track of it. And there will be a couple of things under that threshold that they also keep track of, and typically those are like computers and software or some other important things. Just as in GAAP accounting, how do you come up with the cost for a capital asset? It's the cost of the asset itself plus any costs, and here they use the word ancillary. Any ancillaries costs to put the asset in use. So freight, preparation, setup costs, training. There's a lot of different things that you would need, anything necessary before it's actually fully in service and producing. Donated assets are recorded at the acquisition value. Again, here's another. Why don't they just use the word fair value? I don't know. But acquisition value is basically the price you would have paid if you had to go out and buy it out on the market, which is, things that we've called market value or fair value before. Reported in the governmental activities column and government-wide statements. Just as normal, typically we don't report accumulated depreciation separately. Typically, the assets, long-term assets in the government-wide statements are just reported as assets, net. Net meaning what? Net of accumulated depreciation. Which sort of depreciation method do they allow? Any systematic depreciation method is allowed. Depreciation is not reported for inexhaustible assets. So again, in GAAP, I think the term that we use is what is the word that we say? Something life, we don't say unending life. That sounds like a zombie. But we say, what's the phrase? I can't remember the phrase offhand, but we don't say inexhaustible. Inexhaustible almost sounds like a depletion type concept. But for something where its useful life does not end, land and land improvements and art, we obviously do not depreciate. Because of this, the required disclosures are that we are going to separate out the depreciable assets from the non-depreciable assets. So those get separated out differently. We can see over here on this side, government and activities, capital assets not being depreciated. So land and land rights, construction in progress. And then we have a bunch of and there's a subtotal here, and then we can say here's a bunch of things that are being depreciated, total capital assets being depreciated, and then we have the section of less accumulated depreciation. So here's the total accumulated depreciation. What are my columns? January 1st, additions, deletions, transfers. So the beginning of the month, end of the month, additions, subtractions, and then transfers in or transfers in and out. And then you have governmental activities, capital assets, net, right? So this is what goes on to the statement of net position for the governmental activities. Now you notice we not only cover it for governmental activities, we also cover it for business type activities because governmental activities, typically, remember, we're saying that those are sort of non-exchange transactions, whereas business type activities are exchange transactions. And just in the greater scheme of things, those are two, at least on the government wide activities, we kind of separate those out and track them separately. Capital assets not depreciated, capital assets being depreciated. So this is the not depreciated. This is the depreciated. Here's the total accumulated depreciation. And then you have the subtotal of the business activities net. Now, you notice in this list, we just have accumulated depreciation. We don't show what is the depreciation expense. And so if we go to the bottom here, this is the list of depreciation expense. Depreciation expense was charged to the functions. So when we do depreciation, we actually separate it out by on the government-wide statements according to the function or the program of the primary government. And so we can see what is charged against which area. Whereas you can see the accumulated depreciation is not tracked that way. It's tracked in categories, buildings, improvements, machinery, intangibles. So accumulated depreciation is tracked by type, by classification. The depreciation expense is tracked by which program, because the expense, it goes on their version of the income statement, whereas these items, the accumulated depreciation, is on their version of the balance sheet, which is the statement of net position. So what do you have? The beginning and ending year balances showing historical cost. We kind of went through most of this, sale or other dispositions. Depreciation expense charged to which function? We just looked at that. Historical works of art that are not capitalized for the following reasons. So these can be quote unquote inexhaustible assets if they're held for public, not execution, public exhibition. Sometimes I want to say that, education, but some other purpose other than financial gain, that they're protected, unencumbered, and preserved. Well, why is that second one? What's the idea that they will last a long time? You know, you have to preserve them in order for them to have some reasonable long life. And then if you do, you're not barred from selling anything from a collection of art, but whoever is managing, whatever entity is managing the collection of art, the idea that you sell a piece of art is you're going to take the proceeds and then also use the proceeds to improve or to buy another piece for the collection. So the collection can change over time, but the idea is to kind of keep the total value whole, that as you sell pieces, you use those pieces to buy other new pieces. And maybe it's just the changing nature of your collection. Maybe you've decided to focus on one area versus another. So classifications, these are sort of general things that we've looked at in GAAP. You'll notice a lot of similar things. Land, again, cost of land plus the other related costs, title search, legal fees, but including anything that you need to do to get the land ready for use, for grading or draining. Buildings and improvements other than buildings. Buildings are above ground structures. Now remember, you can capitalize certain expenditures if you improve a building or if you improve a piece of equipment or anything like that. But that does not count as minor repairs. And that's one of those big things that we learn about in both principles and intermediate, that what things do you capitalize versus what things are expensed as minor repairs. So in other words, you put a new engine in the car that gets capitalized, you get a tune-up, or you get an oil change, that's a minor service or repair. Land improvements ready for use, grading, utility installation, parking lot. So certain things are inexhaustible, meaning they're there for all time. When you grade the land, I guess, it could erode. But the idea is that if you move a bunch of dirt, then that's sort of inexhaustible. It's not going to be used up. Things that do get used up, the depreciable items that they call here, the ones that deteriorate. If you install fencing, that's sort of an item that is depreciable. And so even though it's a land improvement, you would depreciate that over time. Can be purchased or constructed. If you construct it using government agencies, you have to remember that you you make sure you account for all the direct and indirect costs that the other funds contribute to the project. And doing those interfund transfers is an important thing. Donated buildings improvements are valued at the acquisition value. Remember, we said acquisition value is the market value. Machinery and equipment, we've kind of mentioned this, purchase price plus any cost necessary to get it ready for use. Construction work in process, the capitalization of accumulated construction costs are reported in the statement of net position. And the reason why is this is a big old asset, right? As we capitalize costs and turn them into this work in process asset, we have to remember, again, that gets reported in the government-wide activities because that's where we have long-term assets and long-term liabilities. We don't have that in the general fund or here in the capital projects fund. Infrastructure assets, so streets, sidewalk, bridges, tunnels, lighting, sewer systems, all that stuff. This is reported in the net statement of net position. Again, that's the government-wide one. Net of accumulated depreciation. They can adopt a modified approach. Now, they don't phrase it this way when they explain the modified approach. I'll explain what they do. They say here, you have to use this asset management system. You have to go out and do an inventory of your assets. You have to do a periodic review, an assessment of the condition of the assets. You have to estimate what is the annual amount to maintain and preserve the assets. You're going to use that amount, the amount to maintain and preserve as your expense instead of a depreciation expense. And then you have to have pretty good documentation. This assessment has to be done every 3 years, and it has to. You have to also show the last 3 assessments. Now, my takeaway from this is it's more of a hands-on or more of a proactive approach than depreciation. Depreciation just tells you, okay, you're starting to use this asset up. You're starting to use this asset up. It's not telling you how much do you need to actually actively put into the asset to maintain it, or to, it doesn't actually go and see. Remember, depreciation is just our best guess at how much we're using it up. That's different from actually actively going out and seeing, well, how much have I used this asset up? That's what we do when we do the condition assessment. So I would just say it's more hands-on approach and more of a sort of a operational management approach to assets than just using depreciation, which is just a book cost, right? We just allocate that cost and say we're using it up approximately this rate, but we don't have any real other data. So the modified approach is sort of actively maintaining your assets rather than just looking at the depreciation going up over time. Intangible assets, they last physical form, have a useful life of more than one period, and are non-financial, right? Financial intangible assets, well, those are investments. Things are patents and copyrights. Well, we see those, but here are some that are specific to a city or to a government. Easements are the right-of-ways on someone else's land. Like my grandpa had this land on the river, but it was behind someone else's land. And so they had to negotiate and write a contract and pay for an easement, which means that little dirt road that ran along the edge of this other person's property was my grandpa's access to his land, which was behind. Otherwise, it was surrounded by other plots of land with no access. So an easements, that sort of thing. Water rights, who has the right to irrigate. If you know anything about California, water rights are a big stinking deal because of people who have been there the longest. They have like free access, or they have unrestricted water rights, and so they plant the most water intensive crops like almonds. Or is it pistachios? I forget. I think it's almonds, because you always see Coach Prime talking about, trying to sell us almonds. But so water rights are a big deal in certain areas. Don't be mistaken. Other ones, we're going to talk a little bit about right to use lease assets. Excuse me. Also, not in addition to lacking physical form, useful life more than a period, also must be separable from the government. And how do you be able to tell that? Can it be sold? Can the rights be transferred? Can they be licensed? Can they be rented? Or if the asset arises from a contractual or other legal right. And again, this is what we've learned in GAAP. Intangible assets are amortized; they're not depreciated. Okay, so continuing on after intangible assets. So if we go back and look, that whole section there was about classification of general capital assets. So, land, building improvements, machinery, infrastructure, intangibles. So let's take a look at general capital assets acquired under lease agreements. This is kind of an interesting thing here. State and local governments usually have limits on the amount of long-term debt they can issue. When reaching their legal debt limit, they often use, I could have maybe put that a little bit more. They often use leases to acquire capital assets. So this feels like it's a workaround, but because it's so common, we'll take a look at it here. A lease is defined as a contract that, it gives the right to use to another entity, non-financial asset, as specified for a period in an exchange transaction. Meaning we pay a lease to lease some object or, a building or something like that. Short-term lease has a maximum of 12 months. You have to remember it has to include any options to extend. Lease payments are recorded as expenditures for the period. At the government-wide, okay, so these are going to be two different ways. Let me see if I can scroll down here. So here we've got these, and we're going to look at it again in the homework. At the government-wide, record a lease liability and an intangible right to lease assets. So here you see here's a liability, the lease obligation payable, and then you've got a lease asset equipment. This lease asset equipment is what we call the right to lease asset, and should be amortized over the shorter of the lease term or the useful life. Now we've got this cash here, and you notice that this number 81078 and these two numbers add up to 81078. Frankly, I would prefer that if you're paying cash for the first payment, that the expenditure would show that as well. But that's how it's done in the homework, and we'll see that here in a second. But where does this number come from? If you can read a little bit, it says there'll be 10 payments of $10,000 each for a total of $100,000. So why are we recording 81078? The reason why we record 81078 is we record the present value of future cash flows. So remember, $10,000 every year for the next 10 years, that's a present value of annuity. Now, if the payments are different each year, or they go up or they go down, you're going to have to present value each individual year. But what you're trying to do is take, what is the current value of $100,000 over the next 10 years? Well, you got to know the rate, and you got to be able to plug it into your table or into your financial calculator. But what they've done here is said that at a 5% rate, $100,000 over the next 10 years is worth $81,078 today. So the expenditure, not only the expenditure, but the payable, the liability, the lease liability, the right to lease asset, at least at its initial stage, and the expenditure and other financing resource are all based upon that present value of the future cash flows. And so here, remember, governmental activities is where we record long-term assets and long-term liabilities. So that makes sense. We have the liability and the right to lease asset. Cash is the first payment, right? Because it's $10,000. We don't present value that because that's cash being paid today. That is the $10,000 today that's the present value. So here we don't call it. We call the right to use asset is a series of expenditures, and the obligation or the lease liability is another financing source. So you can see the special revenue fund is here, but if we were to look at the capital projects fund, it'd look the same. Just notice that it's the same amounts, but because the government activities deals with long-term assets and long-term liabilities, it terms it it puts it in the journal entry in terms of that. Whereas the fund accounting, the modified accrual, only looks at what are the current resources and what liabilities can we currently pay with current resources. So because all of this money is sort of hypothesized because of a present value function, we can put them in, we can record both of those. Some lease disclosure, total amount of the lease, including the accumulated amortization, the amount of outflows of resources incurred period, The principal and interest required maturity presented separately for each of the 5 subsequent years. So these would be in the notes, in the disclosures. You'd say, over the next 5 years, what are the principal and interest payments? And then if it goes longer than that, you would say, okay, and here's subtotals for the next 5 years as groups going forward, and any loss associated with impairment. Many governments have statutes prohibiting governments from entering obligations beyond the current budget year. Because of this, lease agreements typically have a fiscal funding clause or a cancellation clause that allows termination if the funds are not appropriate to make payments. This preserves, I'm not going to call it an illusion because it's real, but it preserves the illusion that it's a year-to-year decision. Typically, you make the decision to enter in these capital projects for over many years. And because some states or some local governments have the rules that we can only consider this year, and we cannot, in other words, we cannot approve funding for future years. We can only approve funding for this year. A lot of times built into these contracts give governments the out that if next year they do not approve the funding, they're not locked into a contract that requires them to keep going. Now, how often does that happen? Well, that's quite rare, but that is something that's built into governmental contracts. Cost incurred after the acquisition. Again, this is sort of the idea of, do you capitalize something or do you count it as a minor service or a minor repair and expense it or expenditure it? Reduction of cost or asset disposal. I think we got some more on that here. Yeah, let's take a look here. So we've all done asset disposal. We've been depreciating it for a certain amount of time and we want to sell it. And so, an example is, let's say I have a truck. It is worth $10,000. I depreciate it on a straight line for 10 years. That means that I'm going to depreciate it $1,000 a year. So after 2 years, the carry value is $8,000, right? It's the historical cost, $10,000 minus 2 years of depreciation, which is accumulated depreciation of $2,000. So that would be 10 minus 2 is 8. And if I decide to sell it, if I sell it right at 8, well, there's no problem. That's exactly the carry value. If I sell it for more, if I sell it for $9,000, I've got to record a gain. If I sell it for less, I've got to record a loss. So same thing here. Just remember that when you do an asset disposal is because when we're tracking long-term assets, remember under GAAP, or at least regular accrual accounting, the carry value is a calculation. It is not an account. We cannot just zero out the carry value. What we have to do is we have to zero out, or we have to get rid of the total value of the historical cost of the asset, as well as getting rid of the accumulated depreciation. So here, whatever it is, we've got a building of $100,000. We've got accumulated depreciation, $80,000. So this is for example, this looks like one that they just demolished or something, and there was no sale. So here they have they retired this building, so probably demolished it, and so they had $20,000 left on the depreciation, so they just call that a loss. Now, if we look at one where we've actually sold something, here we've got a vehicle, $35,000. We also back out the accumulated depreciation, and we receive $3,000 in cash. That means the plug is going to be the loss, or the plug is going to be the gain. Now, notice here that the governmental activities looks just like your normal gain or loss on disposal from GAAP, because governmental activities is accrual accounting. But look at the general fund. It's the same activity, but it's only focusing on this $3,000, right? It's only looking at the current resources. So here, the general fund would only recognize the cash and call it other financing resources, proceeds of sale of assets. So remember that that's how these two differ. The governmental activity looks exactly like accrual accounting. The general fund, modified accrual, only focuses on the current resources. Asset impairment and insurance recoveries. So obviously, if there is a known decline in the, typically we used to say in the value or the useful life of the asset, because both of those could change the depreciation, trajectory. But here, if we want to just talk in real terms, physical damage, obsolescence, new laws or regulations that make some asset that you have unusable. I don't know. Let's say you built a skate park and then a new law regulations outlaw skate parks or something like that. Then you would say, hey, that all of a sudden that asset is no longer useful. Environmental factors. Well, of course, think about the forest fires in California. Those factors can really damage, a lot of infrastructure assets. Impairment is done in one of three approaches: restoration cost, the estimated cost to restore the utility asset. Service units, this is what we call the units of, what do we call it? Darn, I wish I had remembered. But we have a units approach with regular depreciation, and it's basically just breaking it up according to how much we've used it. So the estimated portion of the useful life, think about it as, remember with the truck, you could either say, okay, the truck costs $10,000. And so each year we depreciate on a straight line of $1,000. Or you could say, well, the truck is only good for 150,000 miles. And so what we would do is we would just measure how many miles did we drive it this year, divided by 150,000, and that's the percentage that we would depreciate it by. And that's the units approach. Deflated, depreciated, replacement cost approach. Boy, that's a mouthful. Estimated cost of the replacement asset. So it sounds sort of like restoration is the asset's still there. What do you need to put into it to get it back up to usefulness? Here, an asset is no longer any good, and therefore you are just replacing it. So what is the cost to replace it with? An asset that has a similar depreciation profile and deflated for the effects of inflation. Impairments reported as write down in the carry value of the asset net of insurance recovery. So I don't think most of the times when we talked about in principles, I don't know about intermediate, but when we talked about impairments, we really didn't get into the topic of, a lot of times when you have something bad happen to one of your assets, you are carrying some sort of insurance. And so while the insurance may not be complete, like a complete recovery or a complete new asset, it may be offsetting some of the impairment, meaning you're marking down the impairment, but you got some financial consideration for it from insurance. So that would be the net, the write down of the loss of usefulness minus whatever insurance you got to offset that. It's reported as a program expense in the government-wide statements. And if it's significant, it can be reported as a special item or an extraordinary item. Service concession agreement arrangements. That's when a government has built an asset or has an asset, and then it basically farms it out to either another governmental entity or more likely a private contractor to run on their behalf. A good one is, a lot of times governments farm out the running of their parking garages. Like, let's say they've got 10 parking garages around town, but they're not in the parking garage business, and so they basically get a concession arrangement for someone else to run those parking garages for them. And what do they have? They still own the asset. They still record it as a capital asset, but it's going to be the offset of how much they rent it out for. So whoever is going to be doing the concession will pay them a set fee. The government is probably still on the hook for general maintenance or, keeping the asset in good order or paying for the insurance on the asset. And the difference between those two, so we record the operator's payment as a receivable, as a payment or a receivable, and we have a liability for any obligations to maintain the asset, and the difference is a deferred inflow. So remember I said over time we would see a few places where we talked about what are deferred inflows and what are deferred outflows. And it's more to just, it's hard to describe some of these things. It's more to just look at situations where we say that is a deferred outflow, that is a deferred inflow. So this one's a deferred inflow. The capital projects fund in general, it's just a formal mechanism to track things. Now, sometimes you can track it in the general fund or a special revenue fund. But as we said before, if there is a commitment or some other sort of restriction for the funds, then it's most likely going to be tracked in a capital projects funds. Some jurisdictions have just one capital project fund where they track all of them, and some require them to be broken out into individual capital project funds. Also, general funds and special revenue funds have a year-to-year life focus, whereas capital project funds are known to be focused on the life span of the creation of the asset, and so it goes sort of hand in hand with its special purpose. How some of the general fund accounting that we need to keep on top of is with a capital project fund. Now, remember, we spent a bunch of last chapter talking about the budgetary accounts, the estimated revenues, the appropriations, and the encumbrances, and how do we track those? Well, a capital project fund is a governmental fund, and so you would think that we would have those as well. But fortunately or unfortunately, I'm going to say fortunately, appropriations are not used because it's assumed that the capital project fund, the total amount is an appropriation. So we don't need to break it down any further. If you set up a capital fund for a project, that's the amount that you're appropriating to build the bridge or build the tunnel or whatever you're doing. Estimated revenues are also not used because construction work typically happens only once actual funding happens. Whereas you remember when we say estimated revenues, we're a lot of times talking about we think we're going to collect this much tax, right? And so that would be an estimated revenue. And then as we went through the year, we would say, are we getting close to the amount of tax that we thought we would collect? Whereas with a capital project fund, you get funding, you issue bonds, and now, the other way around. You get approval, you issue bonds, and now you have your funding, and then work starts. So there's no real reason to have an estimated revenue. It's not the same as waiting for a tax to come in. We do use encumbrances, and remember, encumbrances sort of track purchase orders. And so when you have a big construction project like this, obviously, like a general contractor will have a bunch of different people doing a bunch of different things. And so you would want to encumber part of your resources to say, okay, we're going to spend this much on whatever, encumber another part for saying this is this much on another thing. So we would set up encumbrances as a sort of budgetary account. I'm not going to go through all of the illustrative transactions in 5.4. There's a bunch of good ones in here. The ones that I want you to know are going to be done in the homework, so we're going to take a look at that here in just a second. Some last things here. The illustrative financial statements. So I've got, these are all kind of little tidbits. They don't really go through and show you a full set of financial statements, but they do kind of talk about some additional items. So let's just kind of go through them. Some jurisdictions do not require a legal budget for capital projects. And so therefore, remember, if you have a legal budget, a legal authorized budget, you're required to do a budgetary comparison. And because there's no legal budget, a capital project is just funded and then constructed. And so there's no budgetary comparison, just like there's no appropriation or there's no estimated revenues. If there is a residual, in other words, your construction came in under costs. Remember, the idea of the capital fund is that it's a restricted or committed or assigned cost or resources, and therefore it can only be used for that one thing. But once the project has been completed, you can then reclassify it because they no longer are restricted funds because the restriction has now been satisfied. So at the end of the thing, if you came in under, you can reclassify the remaining bond amount or however much money you raised, whatever was left over, you can reclassify and transfer it out to generally the general fund. When you're doing bonds, I'm sorry, that's written correctly. Some jurisdictions prohibit bonds sold at discount. And so typically because if you remember your bonds, you need to have a high enough interest rate so that people will pay a premium. So you want to have, typically bonds will be constructed to where they have a high enough interest to at least make par, and if not, have a premium. Now, how they record the premium is they would record the extra amount that you get from the bond above par as being another financing source. But you won't see, or it's not to say there are no bonds that are sold at a discount, but it's many jurisdictions don't do that because it's just a little bit complicated accounting, and we're not going to worry about it. We're going to say bonds are either sold at par or at a premium. Large scale contracts, a lot of times they give performance bonds, meaning if the contract is not fulfilled on time or is over budget, the government can cash in these bonds if the contractor fails to meet their obligations. Claims, if they've been litigated, that means there's been a judgment, and therefore it's not a contingent liability, it's an actual liability. Claims without judgment are going to become sort of a contingent liability in the terms of GAAP, even though they don't use that word here. They just call it an estimated liability. Bond anticipation notes. So let's say you get authorization for the project, you immediately want to get started, but the whole bond issuing process is going to take a couple of months. You may call for some short-term notes, but what are you saying? You're saying, I want to get some money in right now so I can start getting survey work done. I can start hiring a engineer, or I can start hiring an architect. In other words, there may be things you want to get started on right away before the bond, the whole bond has been issued. So you might issue some short-term notes that ultimately get a little bit of cash in early, but once the bond comes in, part of the bond is used to then retire the bond anticipation note. So it's sort of like a quick start type of funding to get some things rolling before the bond money comes in. If there's a lag between the capital project authorization start date, bonds are sometimes. So here, if the lag is even longer, or for example, let's say you've got a very efficient bond issuance, maybe you're a big city and people will buy your bonds immediately. Sometimes, if let's say the project was authorized, you've got your bonds in place, but because you're doing a bridge and you don't want to do the bridge until summer and this is still winter, in other words, you don't want to be doing construction too early, what you might do is take that bond money rather than just let it sit around. You might take that bond money and reinvest it to earn interest. Now, there are some rules about that. You cannot earn interest higher than what the original interest rate was on the bond, because that results in an arbitrage situation. And if you've had financing, arbitrage is where you're taking the same, financial instrument or the same object, and it has a different price in two different markets. So what they're saying is, what you can't do is you can't borrow bonds. You can't issue a bond at 5%, take the money and turn around and invest it in something at 7%, because that would be arbitrage. Because they're basically saying this is a moral hazard. What is preventing the city or the state agency to say, why would I ever build this thing? Why don't I just say, I'm going to delay a full year? Let me just let the bond money earn interest, because that would be free money. And you don't want to get state and local governments into that sort of investing, to where they're constantly issuing bonds at 5% and then reinvesting at 7%, because they would just pocket the 2% difference. You can do it on a short term, but the idea is if you issued it at 5%, you would invest it at 5% so that you wouldn't be losing money, right? So arbitrage rules, and there's probably actually some pretty sophisticated arbitrage rules required. Multiple period projects require authorizations and encumbrance. In general, most people will assume that this chapter is about multi-year construction projects, although everything we've talked about is sort of within a fiscal year. But that's typically not how projects are done. If you have multi-year projects, you have to have, additional authorization, carryover encumbrances, have closing and opening procedures. But this chapter doesn't go into it too in depth, and we won't either. A special assessment just means, if there's a group of people for which we are putting in some sort of capital asset, we can charge them because it's only affecting them. Just like I was talking about an easement, for example, let's say some developer put in a housing project, but it's only connected to the main road by a dirt road. So maybe they get together and say, hey, city, can you go ahead and make that a city paved road? And we would just charge them because they're the only ones benefiting from it. Let's see. Let's get into sample questions here, and we'll talk about that here in just a second. Okay, so looking at our sample questions here, we have, in which fund would you not record capital assets used by governmental fund activities? Well, which funds are governmental funds? General fund is a governmental fund. Special revenue is a governmental fund. Capital projects is a governmental fund. Fiduciary and proprietary funds are separate. So their capital assets would be tracked separately and be contained within their own funds. So in other words, you can have a capital projects fund that is its own fund, but it is still under the general heading of governmental fund. So the answer here is fiduciary. Another one would be proprietary. Which is not an infrastructure asset. Roads are, sidewalks are, tunnels are. Land draining is not. Land draining is a land improvement. Or depending on how you look at, either it's a land improvement or it's a necessary cost to get land ready for use. Which is not one of the reasons for not capitalizing works of art. Okay, so this list here, held for public exhibition, used to acquire new collection items, preserved and maintained. The one that you cannot do, in other words, if you are selling art for financial gain, that means it has, it can kind of come and go. It's not this idea of an inexhaustible life. So here it's D. 4, infrastructure assets that use the modified approach do not use what? Do not use depreciation. Remember, instead of depreciation, we use that sort of maintenance costs. We also conduct inventory condition assessments, and we also keep inventory records of them as well. So using the modified approach, it means we don't use depreciation as an expense. We use our estimate of the maintenance cost as the expense. Which is not part of the definition of an intangible asset? Well, intangible asset, will have lack physical form. C will be useful life of more than one period. D will be separable for government. The one is it's not financial in nature. So an intangible asset should be non-financial in nature, because if it's financial in nature, it's an investment. When reaching their legal debt limit, governments can use leases to acquire capital assets. This is true, but when you read the sentence and you hadn't really, kind of paid attention to the lecture, it may seem like I'm suckering you into something. But that's what happens. When they reach their legal debt limit, then they turn to leases to acquire capital assets. So that is true. Lease payments in the debt service fund are recorded as the present value of future payments, right? Remember we were saying that it's the present value of all future payments, none of these other things. A fiscal funding clause allows government to lock in future interest payments according to this year's budgetary numbers. That's false. Remember, a fiscal funding clause says a multi-year contract must have a cancellation clause, this fiscal funding clause, which preserves I don't want to say illusion, but preserves the idea that every budget is only looking at this year's revenue or this year's resources and expenditures, and is not approving future years' expenditures and resources. So fiscal funding clause allows that to preserve that concept that if they do not fund the project next year, then they can cancel it without being locked into it. So this is false. Asset impairments are write-downs of asset carrying values net of insurance recovery. Whatever money you get from insurance. So the write-down is the actual loss, no matter which method you look at it, the units approach or the recovery approach. Whatever loss you have are going to write down, you subtract out, or you offset that with the insurance that you get from it. Some jurisdictions do not require a legal budget for capital projects, so no budgetary comparison is needed. That's true. That is true. Okay, so let's take a look now at homework items. And let's see if we got what's going on here. So this one's 15. Let me back up a little bit here. So these are the ones that I think are pretty important. And this first one here is going to be, let's double check to make sure what's going on. It's going to be a couple of depreciation. It's going to be a couple of items here. Let's take a look at each of them one by one. Now, I think your numbers are going to be different, but at least I can walk you through and kind of describe what's going on. The city received a donation. So here, to Parks and Rec to develop a public land. At the time of the donation, the land had an acquisition value of $5.7 million was recorded. Now, remember, if we buy it, well, it's whatever the purchase price plus all the ancillary costs. We're ready to get something for use. If it's donated, we've got to go and figure out what is the market value of this. And that's what that's saying here. Land had an acquisition cost of 5.7 million. So under the general fund, we have no journal entry because remember that the general fund is a governmental fund and therefore it's modified accrual. We do not track long-term assets or liabilities. We track long-term assets and liabilities in the governmental activity. So that's why you see here land, and what do they do it? Program revenue. If you remember, just in general, the general fund does most of its detail work in the subsidiary ledgers, whereas the government activities have different accounts at the journal entry level. So that's that. Public works sold machinery with a historical cost of $35,850. Depreciation of $29 for a cash value of $5,875. The machinery had originally been purchased special revenue funds. Okay, so let's skip the general fund first and look at this. So we're going to, machinery and equipment is an asset. So when we sell it, we've got to credit the asset. That is the 35. Let me see. Is it not quite on the screen here? We're going to credit the asset. We're also going to accumulated depreciation as the contra asset. We're going to debit it for the amount. Debit it for the 29.5. Cash is the amount that received, and 475 is just going to be the plug. If it was an additional 475, would be a gain. It would be a credit, but because it's a loss, because these two numbers do not equal the machinery and equipment, we lost. In other words, the carry value would have been 5,875 plus 475. Now notice that's the government activities is our normal, what we would see under GAAP, because this is accrual accounting. Under the general fund, it's only recognizing the cash sale, the 5,875. So it recognizes the cash and it recognizes it as other financing resources. Number 3, a car was leased. First payment was $1,200, and the present value of the remaining lease payments was $34,000. So here, as opposed to if we go back and just take a quick look, now I don't know why we didn't have the cash payment in this particular one, but normally I would have thought there would have been a cash payment. It says something about assumes the initial payment will be paid through a debt service fund. So maybe it's because it's a service revenue fund and a debt service fund. But this is kind of what I would expect to see from this journal entry. If you notice, just looking at the numbers, all the numbers are the same. It's the titles that are different. So look at the governmental activities. These three titles are what you would expect under governmental activities. They're long-term assets and long-term liabilities. You've got a lease liability, the lease obligations payable. You've got a right-to-use lease asset here. And then you've got cash, which is the first payment. Now, what is the total amount? The 30 the first payment is $1,200. That's the current. I mean, that's the amount of the payment because it's this year. We don't discount it, right? It's the present value of this year is the amount. But all the other years, however many years, it doesn't tell us how many years. The present value of all the other payments is $34,000. So the two together, the payable is $34,000. That's how much the future payments are. This year's payment is $1,200. Together, the right to use lease asset is $35,200. Now, when we go up and we see the very same numbers up here, but they're in different categories. Cash is cash. Rather than being an asset, we have an expenditure. And rather than being a payable, we have a financing source for those two. So that's going to be a good question for me to use, when I say, okay, can you give me the journal entry? You for this one, you'll pretty much have to remember that it's the exact same numbers, but different titles. During the current year, a capital projects fund completed a new public safety building. The cost of the project was $9,845. Current year construction costs are $745. The full cost is attributed to the building because it's constructed on city-owned property. The building came in $5,500 under budget, which is transferred to the general fund. Okay, so we have the capital project fund, which is completing this activity, or at least this year's part. The general fund is transferring out what is left over. And the governmental activity is recording the full completed asset. So let's take the governmental activities because typically we're more familiar with GAAP accounting. So here, each year we're spending cash. Right here we spent this year we spent $745 in construction costs, and we added it to our ongoing construction in progress asset. Right. Now, this construction in progress asset, because we're completed this year, this 745 kept being added on to previous amounts, and the total amount is this 9,845. And since we've completed it, right, the completion of the new safety building, we're going to go ahead and convert that whole construction in progress into a new asset. And so the asset becomes this. So we record this year's amount that we built. And then because it's completed, we complete the final building, complete the final construction into a new asset. When we look at the capital project fund, all we're doing is recording this year's expenditures. So cash becomes an expenditure. Now the amount left over ends up being transferred out. So we take the cash out of the fund, right? So that's a credit to the cash of this fund. And we set it up into this sort of temporary account, the transfer out, and then the general fund transfers it in and books the cash. The city records a half year, so make sure we focus on that. City records a half year of straight line depreciation. Capital assets placed in service during the year. The building in item 4 above have an estimated 30-year. So let's see, that's 9,845,000 divided by 30, right? And then we said we had a half year, so divided by 2. So that's going to be 164,083, 3 repeating. So that's what we got, 164. So remember, there's no long-term assets or liabilities. Therefore, there's no depreciation, accumulated depreciation, which remember is a long-term contra asset. So here we've got no journal entry for the general fund. We've got accumulated depreciation and the depreciation expense for the buildings here for the half year. Due to technology developments, the city determined, so here I think this is an impairment, yes. It's an impairment loss due to technology obsolescence. Again, this is, obsolescence is an impairment of a long-term asset, so therefore there is no general fund, which only deals with current resources. but the governmental activity will be an impairment of the 1206. So we'll expense it, and the machinery and equipment will be credited, will be reduced by that amount of obsolescence. Let's see. So that was sort of a long one. The middle one is not as long. Number 14, it's a pretty short one. And then 15 is a little bit longer again. Okay. So here's a lease. So we're taking a look at a lease. The city agreed to make an initial payment of $1.4 million, annual payments, same amount for the next 29 years at 6% discount. The present value of the lease payments is $21 million. Upon completion, the building had an appraised value of $13 million, estimated useful life of 40 years. So we had one in the previous one, but here's another example. I just want to make sure that you understand how to do this. So obviously you can probably figure out that I'm going to ask one of the. This is a big candidate for being asked something. So let's, again, tackle the government activities first, because that will be more similar to our gap training. We are going to record a right-to-use lease asset at the total of the present value of the total payments. The total present value of the total lease payments is $21 million. We record that. The current payment is $1.4 million. And because that is this year's payment, we don't discount it. That's the amount that goes in here. That means the rest of the year's payments is the difference. So 21 million, just to make sure, 21 minus, I mean, it's going to be it, but just minus, so 19,560,729. So that's going to be the lease liability. We're going to use these very same numbers up here in the capital project funds, except we're going to call cash as cash. The asset is the expenditure, and the rest of the present value of lease payments is other financing sources. I think there's some questions. Which financial statement prepared at the end of the fiscal year would show both the asset and liability related to capital lease? Well, government-wide would show both the asset and liability. So this is the key here, that the governmental fund doesn't show assets or doesn't show long-term assets and liabilities. It only shows this expenditures and finance sources. So that would be the government-wide statement. Well, you notice all of these say government-wide. Net position is the balance sheet version of the government-wide statement. The income statement is government-wide statement of activities and changes in net position. So those are the two. So net position is going to be our quote-unquote balance sheet for the government-wide statements. Would the accounting for the lease change if the lease included a cancellation clause? Nope. It'd stay the same. $15, this one, I like this one. It's divided up nice and understandably. So here we are authorizing to create something. And let me see, what are we creating? We're creating a library. So we've got 4 different sources of funding for this library. So we got 1, 2, 3, 4. So numbers 1, 2, 3, and 4 are going to show us how we record the different types of funding for this library. And then in question number 5, we're going to complete the construction of this library. And then in 6, we're going to close down this capital projects fund because it's finished, right? It's finished, and so any residual we need to transfer out and make sure all of that gets done correctly. So these are kind of a good 3-step. Let's take a look at the funding. The county issued $6.3 million of 6% bonds at par, right? We don't want to issue at discount. We only issue at par or premium. And if we had a premium, we'd have to show some other source of funding for the amount that was on premium. Proceeds from the bonds were used for the construction of the library. So the governmental activities is where we're going to show our liability. So the bond payable gets issued here, cash. The project fund shows cash, but it determines it as a financing source, the proceeds from bonds. A $680,000 federal grant was received to help finance construction. Again, cash. Now we're going to count the federal grant as a program revenue. Now, again, governmental activities are more detailed in their journal entry accounts, whereas the governmental funding does all the detail in the subledgers. So here, almost the same. In fact, both of them are revenues and cash of some sort. The library special revenue fund transferred. So we have a bond, we have a federal grant, and we have a transfer from another governmental unit. Now, notice here the transfer from another governmental unit does not have a journal entry in the governmental activities, because at the governmental activities level, receivables and payables all get netted out. And so there's no particular thing to record of the governmental activities. But because the funds are tracked separately, we do have to show as a transfer in. So if we went to the special revenue fund, we would see the same journal entry in the special revenues fund, but as a credit to cash and a debit to transfer out. But we don't show that here. Construction contract was awarded in the amount of $6.83 million. Now here, remember I said we don't do appropriations, we do not do estimated revenues, but we do encumber. And so the total amount of the funding, if I went through, is this the total amount? It probably is close. Actually, it looks like it's maybe not. So we have raised the cash, but it looks like we awarded the contract for slightly less than the total amount. But we're going to use encumbrances to help us, I guess, manage as the different purchase orders come in for the contract, that we can use encumbrances to track them and set aside and earmark the funding, because this is the funding that we have, and so we want to keep to essentially to budget. So, of course, encumbrances aren't done in governmental. Encumbrances are a budgetary item. Budgetary items are also only done at the governmental fund level. Number 5, the project was completed 4 months ahead of schedule. I don't think we have anything that was worried about the 4 months. Total construction expenditures for the library amounted to $7,248,500. Settled with cash. When the project was completed, the cost of the library was allocated as follows: land, building, and the remainder to equipment. Okay, so now this would have been incremental. We don't know if they were doing this every month or every quarter, but every time that they were, paying off some vouchers or paying off some expenditures, they would put it into construction work in progress. So we paid the cash, and here we're just showing as the total cash is a construction work in progress. That is a work in progress asset. Now, when we get ready to complete it, we're going to take that total amount in the work in progress account, and we're going to convert it into actual assets that we put on the balance sheet. And it says here, $215 to land, $6.31 to the building, and the balance to machinery and equipment. So that's the long-term assets and liability, or just long-term assets here, that we used on the governmental activities. Now, what are the numbers that we're concerned about up here? You notice that we don't record any land, buildings, and machinery up in the capital projects funds. We're just looking at the inflow and outflow of resources. So first thing we need to do is we set up an encumbrance here, a debit to encumbrance, a credit to encumbrance outstanding. Remember, we're just using those to track how much we're spending to make sure we don't overspend, or at least give us a sense of how much we're overspending. When we're getting ready to close down this project, or when we have now, encumbrances are before the expenditures happen. So we now are spending the money, the expenditures are happening, so we need to go ahead and undo the encumbrance. So we're just going to reverse out the encumbrance and the encumbrance outstanding, because now we've got actual expenditures to take the place of encumbrances. So we've got a cash credit, and the construction expenditure is the $7,248. When we get ready to close the account, okay, the capital fund's temporary accounts were closed to fund balance restricted. Now, the resources are restricted because they were obtained from a bonded debt issue exclusively for library construction, right? So they have a restricted use, but once the library's constructed, that restriction is lifted because its restriction has been fulfilled. So we are able to transfer the remaining funds. We're able to reclassify the remaining funds and transfer them out, typically to the general fund. Here it says transfer the remaining funds to the debt service fund for use in the debt repayment, which is also a possibility. So the capital projects fund, we're going to take the construction expenditures that we have listed here, right? Construction expenditures are right there. We're going to back those out, and we're going to place them as, here's the the proceeds from the bonds, which is all the way up here, 6.3. We're going to, the transfers in, which is the 2.8 here, the transfers in, and we've got 680 from, we've classified as revenues, which is going to be the grant money. See, we classified them as revenues. And so we're going to allocate that and say, if I add those numbers up, let's see, 63. $7,260. So remember when I was saying it looked like if we looked at the 7,260, if we looked at the actual contract awarded, when we awarded the contract, when the contract award was 6,830, you notice that was more than the money. It was less than the money that we had taken in. So it ended up that the actual amount was closer to the total amount that we took in. But you can see, if I subtract out what the total costs, actual costs were, 7,248, 500, it means that we were under. I don't want to say under budget, because we gave a contract at 680 or whatever the contract was, but we had collected funds. We were under our funding limit. So the amount of remaining funds gets classified as a fund balance restricted. We're going to now be able to send that out. I actually would do 6A, then 6C, then 6B. Because look, you end up with a fund balance restricted, and I would then do this. I would close the fund balance restricted and put it as a transfer out, and then I would use the transfer out as a cash for the debt service fund. That's how I would do it, but they've done these two backwards. Of course, all of this closing of the capital projects fund account has nothing to do with the governmental activities. All of the work in the governmental activities has been done here in the recording of the assets. Okay, let's see. That should be everything we got here. As far as the exam, I'll be putting up the quiz this weekend, so you can start practicing on the quiz. I'm thinking I'm going to pull 12 questions from the quiz, so that would be 60 points. And then I think I'm going to pull 10 questions from the quiz. That'd be 50 points. I think I'm going to pull another 10. I'm going to create another 10 questions that will be worth 3 points each. So that'll be a total of 80 points. And then I will also put a document up of the journal entries that I would like you to know. It'll probably be 10 different journal entries, of which I'll select 5. And the journal entries will probably be 2 points each. I've decided with the write-in journal entries, I'm going to make them 2 points each, so that allows me to, if you get it all correct, I can give you 2 points. But then if you only get part of it right, I can still give you partial credit for 1 point each. And then obviously if you get too much of it wrong, that'll be 0 points. But that's kind of how we'll break it out. You'll have a quiz, of which I'll select 10 questions from the quiz. That will be 5 points each. And then I will make up another 10 questions that will be 3 points each. And the 10 questions will come just from studying the outline, the handout, and then the journal entries will come from, I'll put up another document, but they'll come from basically the homework items that we've gone through in these last 3 chapters. But I will select probably a group of 10 journal entries that I would like you to know, and use 5 of them on the exam. And of course, the exam window will be next Wednesday through Sunday. So hopefully you'll have plenty of time to prepare. If you have any questions, please let me know. I don't anticipate meeting on Wednesday unless I get any emails that you would like me to have a session to go over quickly, sort of the the uh, the exam or the preparation for the exam. And then after that, we'll continue on with chapter 7. All right. Take care, and I will talk to you soon. Email me if you have any questions.